All right, good morning and good afternoon. So, we'll be doing a weekly review for this week's market. All right. So, on Monday, we indicated that we're interested in these relative equal highs here and also these highs. So, we got this buy side liquidity resting above here. So, we had buy side liquidity resting above here, which was the John liquidity going into this week's market. Let's check the intraday trading. So we had FOMC on Wednesday's trading during the afternoon session. So we had this consecutive up close candles, these consecutive up close days, and we indicated that when you're bullish going into every day's session, you are expecting the market to go below the opening prices and then trade above the previous daily's high. So when you're bullish, you are interested in price join towards the previous day's highs. So Monday's trading, we were targeting these highs here and also these highs. So if you to understand what is going to be explained now in this video, you must first watch the video on the market on the weekly forecast to then understand this review. All right. So after Monday's trading, we had the next this candle, which is Tuesday's candle, Tuesday's candles. So we opened here and then dropped lower. The Judas was carried out for below the midnight opening price. Then we rallied for the Monday's highs, which is these highs here. So when you're bullish, you are interested in price taking out the previous day's highs. So here is the previous day's highs. Then here is Tuesday's highs. And here we have Wednesday's highs. So when the order flow is in a one-sided direction, you'd want to be mixing more of your equities on the buy side, expecting price to go for the higher prices. This does not mean you cannot be a short-term seller inside of a day's range. So to get the price action that took place clearer through the week, let's dive right straight into it, the 1 hour time frame. So each highs here are the previous day's highs from Monday's trading, Tuesday's trading, and also Wednesday's trading. We are not covering Thursday's trading currently now because we are in a new day's trading, which is Friday's trading, and we have already reached our John liquidity, which is this buy side liquidity. So we are not interested in taking any more positions again because we have reached our target. One thing as traders to understand is that you do not want to be pushing your edge continuously. You'd want to be more focused on capital preservation. So when your John liquidity from the higher time frame has been reached, you'd want to stand down and do nothing until the market gives you an indication on where price is likely to join next to, because we've been predominantly bullish, targeting these highs here. This buy side liquidity now is the high from the weekly time frame, and we get our narrative from these higher time frames, which the lower time frames are thus subordinate to. So after Monday's trading here, so first we indicate Sunday's opening price, because Sunday's opening price is the true opening for the week's trading. So here we have Sunday's opening price. So let's make that a gray color. So as you can see, true openings are fair value. After Monday's opening, price make the low of the week on Monday's trading during the morning session. Then we add a rally higher. Then you see we left this bullish order block here, which took out this lows here. So this right here is a bullish order block, because after these lows were taken out below the Sunday's opening price rallied higher. And if you take your fib from this low to this high, here you have the optimal trade entry. So let's do that. So if you take your fib from this low to this high, and then you impute the OTE, so you see here you have the optimal trade entry 0.618, and this other level 0.79 and 0.705. So these are the sweet spots. So we had price expand higher here. After expanding higher, we came to a discount PDRE, which is this bullish order block. So if you take this to this as your dealing range, so this is your trading range, and you are looking for a one shot one kill trading approach going into this week's trading. If, for example, we're using the narrative which was illustrated from Monday's weekly forecast, so if you are to take, for example, a one shot one kill, you'd be using this, you'd be aiming for price to come for discount PDRs, probably this fair value gap here. So you see, if you zoom further here, we have this fair value gap here. So we have a fair value gap here, which is also coupled with a bullish order block. So when you are bullish, you're interested in price going for discount PDRs inside of a well-defined trading range. So when you have a well-defined trading range, you are expecting price to seek discounts. Then as a buyer, because we are expecting higher prices, we are expecting price to go for buy side liquidity, we are anticipating price to go for discounts, to purge out discounts, sell side liquidity, and also at discounted PDRs. So we came for a discount here at Tuesday's trading during the afternoon session. So we came for discount here, and then rallied higher here, chopped up and down here, and then came lower. So this is an indication of, this is a typical example of an FOMC week. So when you have FOMCs on Friday, on Wednesdays, price leaves a 50-50 sentiment in price, so as to generate both buy side liquidity and sell side liquidity from market participants. So early traders that entered probably year, they would have adjusted their stop losses to these lows or the bodies low here, because bulk of the volumes is at the bodies of the candles. The bodies tell most of the stories, but the candles do the damage. So because these candles are doing damages, uninformed money speculators, they will see this as these weeks are irrelevant, so they will adjust their stop losses from here to these lows, below this body's lows, which is just resting at this fair value gap here and just at the around the midpoint of this bullish order block. So I'd want you to on your own go into this order block here and identify what makes this a bullish order block, and I want you to dissect the anatomy of this order block PDRA from the equilibrium, the first, second, third, and fourth quadrant. So you dissect this order block here because it is of importance going into this previous week's trading. All right. So what do we have here? So price trades down on Tuesday's trading, down during the afternoon session, rallied higher, chopped up, created this relative equal highs here, but which is buy side liquidity. So the algorithm doesn't like seeing things like this. So price left buy side liquidity here. So we just call this buy side liquidity. So price left this buy side liquidity here and then dropped lower, making the uninformed see without that doesn't have the higher time frame narrative in play in mind. So when they do not have this higher time frame narrative, which was gotten from the weekly down to the daily time frame, from where we had our draw liquidity at this left hand side of the chart, because they do not have a conceptual knowledge of how the algorithm books price, they will think this is a strong resistance level. So price will be coming for support and going lower. So they will place here as a support level and here as support level. So they're expecting price to go from a strong resistance to a support level. But as you can see, from hindsight, price doesn't do that. From hindsight, price doesn't do that. So once again, on Wednesday's trading, during the morning session, we traded inside of this fair value gap here, down below, just below Sunday's opening price here, and doing FOMC also, we had this fake rally higher, which is the actual move, but this move will make the uninformed place their stop losses below here. So this is the market engineering sell side liquidity. The market always tries to seek as much liquidity as possible so as to facilitate an efficient market delivery. If there's not enough liquidity to take the market to the intended direction, the market will go into a range bound price action to generate sentiment, which it did here, so as to generate sentiment on both sides of the market, on the buy side and also on the sell side. So this is it, creating sell side liquidity here during the morning session, just before the FOMC release, which was at 2 p.m. At 3 p.m. we dropped lower, fill this fair value gap here, and then we dropped just at the 0.79 level of this candles of this trading range, from this low to this high. So we are at a discounted level. So there's multiple confirmation telling us that we are indeed coming for buy side liquidity and above. We are not treating buy side liquidity as a resistance level, as a purely resistance level, or sell side liquidity as a purely support level. We are seeking price to go through those levels. We are seeking for price to go to those levels and through those levels. All right. So this is what we had here. We had price go to it and then through it. So yesterday's trading being Thursday's trading. So after this consolidation, price rallied higher, left this other block here, which is inside of this other block, making this a bullish proportion block here because it is resting at an order block. So you buy here at the equilibrium of this range high to this range low. You buy at the equilibrium, targeting buy side liquidity, targeting the previous day's highs. So we left this here this is a breakaway gap. So when you have price fill a favorable gap like this, which coincides with this other block, then price values higher. You would have to spend a lot of time in the charts doing tape reading, because this will help you understand the hierarchy of PDRAs to understand when a an imbalance is to be filled or to be left unfilled. For example, this there's a narrative being in play why this imbalance was left unfilled. So because this imbalance was left unfilled on Tuesday, on Wednesday's trading, going into Thursday's trading, you do not want to see price come for this imbalance again, because we have filled this imbalance here, docked inside of this bullish order block. So we are prices indicating bullishness in the algorithm. So we are not interested in this in price coming back for this imbalance here short term. So price went just shy of the first target, which is the -5 standard deviation, which is 5,741 for of the US500 capital.com. So on the dollar, going into this week's trading, we're expecting the weekly candle to drop lower, seeking sell side, and also specifically at the 100 round figure, which is about here. So our general liquidity is the midpoint between this candle's low and also this candle's low. As illustrated earlier from the weekly forecast, the midpoint between two liquidity poles is fair value. So on your own, indicates the midpoint between this low and also this high. So we just go right straight into the 1 hour. So we'll delineate each day's trading from Monday's trading to down to today's current Friday's trading. So here we have Wednesday, Thursday, and then Friday. So Wednesday made the high of the week for the dollar. Hence, so Wednesday made the high of the week for the dollar. So every time you analyze the chart, especially for a weekly forecast or a weekly review, doing your weekly back testing, you have to always indicate the Sunday's opening price, because Sunday's opening price is like the midnight opening price or the 8:30 opening price, which is paramount to understanding the order flow going into the week's trading. So here we have the Sunday open. So here we have the Sundays open. So Monday's trading traded lower, left this relative equal lows. These lows here, the algorithm sees this as relative equal lows, because retail will place their stop losses below these lows, expecting higher prices, because they see this as a strong support level. So price rallies higher and meandered around, then dropped lower here to neutralize these buyers here. So when it does that here during Wednesday's trading at FOMC, then we add this rally higher. This rally higher now will make the uninformed see this as the dollar trying to go for higher prices. Meanwhile, this is the manipulation leg for the week. So if this is a power of 3 for the weekly time frame, for the weekly view, this is the accumulation. This is the market accumulating positions by smart money. Then price took out this sales idea and then manipulated higher, making them see this as price trying to make a high. So as price going for highs. for higher prices. So when price took them out here, they will still think the as a false breakout, meaning price is going for higher prices, which price made them think here with this Judas. Now this Judas now will make them reinforce their idea that this is a strong support level. Let's indicate this with a very thick candle. So they'll see this now as a strong support level. So they'll place their orders here and probably their stop losses at below the midpoint of this week. So you want to take your just below the midpoint of this week or at the low of this candle here. So here you'd want to watch how price acts. So when price trades here, price will trigger their entry for them, expecting price to go from a support level down to a resistance level. So here is the support level in their mind's high, and above here is the resistance level, and they also have other higher resistance level up there. So when price rallies higher here, they will not take anything here, they will not take any partials, because retail doesn't see the need for taking partials when trading. So hence we use this against them. We use their own greed against them. So as we were saying earlier, so now they will see this as a strong support level, and this as a strong resistance level. They will see this as a strong support level, and also this as a strong resistance level. So, and price does not respect the typical support and resistance idea of price. We do not subscribe to that theory of support and resistance. The actual support and resistance is PDRAs. Think of support and resistance as price respecting PDRAs in line with order flow. So when order flow is bullish, discount PDRAs will act as support, taking price higher, and premium PDRAs will fail to act as resistance. They will be pierced through and they will act as a resistance broken turn support. This is how you should view support and resistance going forward. Support and resistance is real, but not in the sense how we've been taught how support and resistance is real. So continuing with this, when price came down here and rallied higher here, they will not take their partials here at Sunday's opening price, because we are bearish for the dollar and price has left Sunday's opening price here at Wednesday's trading going into Thursday's trading. We do not expect to see a body's close at or above Sunday's opening price. Hence, you see on Thursday's trading, the wicks were going above this Sunday's opening price. The algorithm sees this as the wick doing damages to traders here, but the bodies, you see how the bodies is respecting a close below this price here, and which also coincides with this new day opening gap. On your own, go into your chart and indicate the new day opening gaps in this week's trading, from Monday trading to down to Thursday's trading. Indicate every new day and new week opening gap you can see on your chart. All right, so that's it for that. So we're expecting the highest body of this candle now, of this Thursday's candle, to act as a resistance PDRA to take price lower to these lows and down to our target, which is this 100 round figure level. So this is our target for the week, 100. So let's make this a golden color. I think there's an orange color, I don't know. So this is our target for the dollar. We might get to it this week or probably on Monday's trading. So, but we do not want to see bodies close above this Sunday's opening price. So I hope you got something from this video, and I'll talk to you next week. and always tune in for, like I said earlier, we'll be having weekly forecast on Sunday or Monday's trading, and also a weekly review on Friday or Saturday's weekend. All right. So have a nice day and good luck.